Good evening, learners. Last classes we study about the money supply, price level, the relationship between money supply and price level through two approaches: quantitative theory of money and which is Fisher's approach and Cambridge approach. Besides this, we also study about the Keynesian approach also. Keynes, according to Keynes, the money demanded for three purposes, three motives, that is transaction motive, precautionary motive, and speculative motive. Money demand function is a decreasing function of interest rate, and it is constructed for a given income level. Money supply is fixed by the central bank. Then intersection between money demand and money supply derives the equilibrium point in the money market. And an increase in the nominal income increases the interest rate, and while an increase in money supply decreases the interest rate. Today we discuss about the monetary policy. Monetary policy is the when an increase in money supply leads to decrease the rate of interest. Decrease in interest rate leads to increase in investment, which in turn leads to increase in aggregate demand and growth in the GDP of the economy. A very low rate of interest, however, would discourage people from keeping their savings in financial institutions like banks. So the concept of liquidity trap, which may operate at a very low rate of interest. On the other hand, a high rate of interest will increase the cost of borrowing, which thereby reducing the demand for credit, which in turn will reduce the level of investment and economic growth. From the supply side, adequate supply of money facilitates smooth functioning of the economy, while excessive money supply may lead to inflation. Thus, from a monetary policy perspective, it is important to decide upon the quantity of money to be supplied, since it has repercussions on the rate of interest, which affects the goods market and aggregate demand. So it also has implication on price stability and inflation also. So monetary policy is important for the economy of country's economic. Demand for and supply of money are regulated by central monetary authority, especially central bank of the country. The central bank of a country has several functions to perform. Traditional functions of a central bank, such as banker's bank and lender of last resort. But besides this, there is other functions are there in the functions of the central bank. Nowadays, there are many functions can be for the RBI. First, formulation of monetary policy, regulation and supervision of the banking and non-banking financial institutions, regulation of money, foreign exchange, and government securities markets, as also certain financial derivatives. Fourth, debt and cash management for central and state governments, management of foreign exchange reserves, foreign exchange management, current and capital account management, banker to banks, banker to the central bank and state governments, monitoring of the payment and settlement system, currency management, development role, and undertaking research and collection statistics. These functions are uh, these are some functions of RBI. The RBI designs and implements the regulatory policy framework for banking and non-banking financial institutions with the aim of providing people access to the banking system, protective depositors' interest, and maintaining the overall health of the financial system. And along with these, management of public debt, management of foreign exchange rate and foreign exchange reserve, determination of interest rate, maintenance of inflation rate, and facilitating of high economic growth have become quite complex of the functions of RBI. So RBI has much more functions which can control the economy of the country and control inflation rate also, and also facilitating a high economic growth. Then objectives of monetary policy. Monetary policy is a mechanism through which the supply of and demand for money in an economy are regulated. Monetary policy regulates supply of and demand for money. Such regulation on supply of and demand for money are expected to fulfill the objectives of monetary policy. So, monetary policy indicates the direction in which the policy variables should be aimed at reduction in inflation, achieving full employment, realizing higher economic growth. On the other hand, targets of monetary policy are the variables targeted, such as money supply, bank credit, and short-term interest rates through the instruments of monetary policy. Thus, a central bank would have a single objective or multiple objectives to follow. The primary objective of most central banks today is price stability. Price stability does not mean that there should not be any price rise in an economy. Rather, the objective is to have moderate inflation. Very often, many countries have come up with monetary policy that targets inflation rates. Such inflation targeting is followed in India also. Inflation targeting was introduced for the first time in 1990 in New Zealand. Then, many countries such as Canada, United Kingdom, Sweden, Australia, Chile, Poland adopted inflation targeting as the objective of monetary policy during 1990s. India formally changed the RBI Act and adopted inflation targeting in 2016. The RBI formulates monetary policy in such a manner that inflation rate remains in the range of 2% to 4% per annum. Then, and higher economic growth is important function of the monetary policy or main objective of monetary policy. An important objective of the monetary policy is to realize high economic growth. Economic growth leads to higher per capita income and higher standard of living for people. As higher investment is crucial for accelerating economic growth. An expansionary monetary policy decreases the rate of interest and increases the investment and output, thus increasing the rate of growth of the economy. Then full employment level. Another important objective of an economy is provision of employment to people. We observe that unemployment of resources, including human resources, exists in an economy. During recessionary periods, the level of unemployment increases. Thus, there is a need to formulate policies that generates employment and takes the country forwards full employment. At full employment level of output or potential output, all the factors of production are fully employed. However, this does not imply that there is no unemployment. Full employment is associated with a positive rate of unemployment due to people switching jobs. Such an output is also called full capacity output. Monetary policy can help in realization of full capacity output by influencing aggregate demand. Then price stability. Price stability means that the price increase should be moderate. The objective of price stability may be in conflict with other objectives such as economic growth and full employment. Any increase in aggregate demand via an expansionary monetary policy is typically inflationary. If there is shortfall in aggregate demand, there could be a tendency towards deflation in the economy. Monetary policy should aim to avoid both inflationary and deflationary situation. So, inflation in price stability is avoid this situation and and came to the country's the constant price stability situation and it in a moderate situation. Then exchange rate stability. Monetary policy could affect the balance of payments of an economy via the interest rate channel. Interest rate plays an important role in foreign investment in the economy. If there is a decline in the rate of interest, it may result in capital outflows. Consequently, the demand for foreign currency increases and this results in the depreciation of domestic currency. Depreciation of currency may have several consequences. Value of domestic currency declines in terms of foreign currency. Foreign goods become more expensive and import of essential commodities such as raw materials and inputs may decline, which results decrease in GDP. As domestic goods and services become cheaper in terms of foreign currency due to depreciation, exports of country may increase, which improves the balance of payments position. The final outcome however, depends on several factors such as elasticity of imports and exports and global economic environment. So, exchange rate stability also one objective of monetary policy. Balance of payment affected by the monetary policy. So, and in here, in case of that, interest rate plays important role in foreign investment in the economy. And through the depreciation, import is more expensive. So the people export is promoted through depreciation, which overcome the balance of payment. Then instruments of monetary policy. They are the instruments of monetary policy to control credit are divided into two categories, quantitative and qualitative. Quantitative measures are non-discriminatory in nature. When a certain interest rate is set by the central bank of a country, that rate applies to banking system of the country as a whole. But in case of qualitative or selective measures vary from one section of society to the other. Quantitative instruments are repo rate, bank rate, open market operation, change in minimum reserve ratio, change in liquidity ratio. Repo rate. The repo rate is the rate at which commercial banks borrow money from the RBI on submission of collateral such securities. Similarly, commercial banks can deposit their excess reserve in the central bank for which the reserve repo rate is applicable. The repo rate is periodically decided by the RBI. Other rates such as reserve repo rate, bank rate and marginal standing facility MSF rate are automatically adjusted as a fixed percentage above repo rate. The RBI uses repo rate to manage inflation, economic growth and balance of payment. When inflation rate is high, the RBI can increase repo rate so that interest rates increasing which decline the aggregate demand. On the other hand, the RBI can decrease repo rate when economic growth is sluggish. The RBI can decrease repo rate when the banks are allowed to borrow from RBI at repo rate under the liquidity adjustment facility. Deposit of excess liquidity with RBI is also made under liquidity adjustment facility. This management helps the bank to manage liquidity pressure and resolve short-term cash shortage. In addition to the liquidity adjustment facility, the RBI has marginal standing facility, which facilitates provision of overnight loans to some commercial banks. The objective is to meet unanticipated shocks such as large-scale withdrawal of cash by customers. The marginal standing facility does receive a penal interest rate above the repo rate. Then bank rate. Bank rate is the rate of interest at which the central bank provides loans to commercial bank and other financial institutions. Increasing bank rate has the effect of increasing the rate of interest in the economy. Decrease in bank rate lowers the rate of interest in the economy. Higher bank rate lowers the extent of credit creation in the economy, which leads to a decline in aggregate demand and which affect the prices and it decrease the price level. On the other hand, in a recessionary phase, a lower bank rate is proposed. It is difficult to predict the impact on change in bank rate on bank borrowings. This is because bank rate itself is not the key lending rate. The is dodged from the basis for the multiplicity of RBI's lending rates charged for different types of advances. The impact of change in bank rate on banks' borrowing depends on various factors such as 1. The degree of bank's dependence on borrowers' reserves. B. The sensitivity of the bank's demand for borrowed reserves to the differential between their lending rates and borrowing rates. Third, the extent to which other rates of interest have already changed or changed subsequently. Fourth, the state of the demand for loans and the supply of funds from other sources. Banks are not discouraged from borrowing in the face of higher bank rates if the market interest rates are high, such that banks expect higher returns from borrowed funds. Financial institutions can borrow from the RBI at the bank rate without submission of any collateral. On the other hand, repo rate is charged for repurchase of securities issued by the RBI. Further, bank rate is higher than repo rate. Then open market operation. The central bank exercise control over the money supply through sale and purchase of government securities. The term open market operations refers to the sale and purchase of government securities by the central bank to or from the public and banks. While purchase of government securities in open market increase the high powered money and open market sale of government securities decrease the high powered money by an equal amount. So, H, the usual money multiplier process leads to change in money supply. Then, to follow a contractionary monetary policy to check inflation, the central bank decreases money supply by selling securities. In a situation of falling prices, the central bank buys security for increasing the money supply in the economy. Such an expansionary monetary policy helps in boosting aggregate demand and reviving the economy from recession. Open market operations are flexible and reversible in time. Hence, it is considered to be an efficient instrument of monetary control. Moreover, unlike bank rate and reserve requirements, it is free from enhancement effects, as no prior public enhancement has to be made to conduct these operations. The direct effect on H is immediate, and the amount of H created or destroyed is precisely determinable. There are indirect effects also, such as interest rate changes. So, the open market operation is free from announcement effects. There is no prior public announcement has to made to conduct this operation. Because of that, the H high powered money created or destroyed determinable. Because of that, indirect interest rate changes also shown. Purchase and sale of securities in an open market by the central bank or the monetary authority is popularly known as open market operations. In order to contract the credit in the economy, the central bank sells security in the open market. This leads to fall in aggregate demand and reduction in price level. Whereas when credit is to be expanded, there is purchase of securities by the central bank in the open market. This leads to increase in aggregate demand and production levels in the economy. So, in case of the purchase of purchase of securities in open market is increase aggregate demand and production, whereas when sale in the open market operation is decrease the aggregate demand and reduction in price level. Then cash reserve ratio. A certain function of total asset is always kept by banks as cash partially to comply with the statutory reserve requirements and partially for meeting day-to-day cash payments. Cash is held as cash on hand and as cash balance with the central bank. They are known as cash reserves of banks, which are classified as required reserves and excess reserves. Banks are statutorily required to hold cash balance with the central bank. In India, the RBI has the power to impose statutory cash reserve ratio (CRR) on banks anywhere between 3 to 15% of the net demand and time liabilities. A higher cash reserve ratio implies lower liquidity in the system. That when the central bank plans to increase liquidity in the economy, it decreases the cash reserve ratio. Cash reserve ratio varies across country. For example, in 2019, it is as high as 45% in Brazil and as low as 1% in the European Union. In India, as on April 2019, the cash reserve ratio was 4%. Further, CRR varies over time for the same country depending upon the economic environment. Banks also hold excess reserves apart from required reserves. These are held in excess of required reserves. These excess reserves are usually used to meet the currency drains. That means the net withdrawal of currency by depositors and cleaning drains, which is the net loss of cash due to cross clearing of checks among banks. So, large part of excess reserves is held as cash on hand. Remaining small part is held as excess balance with the RBI. By varying the reserve requirements, the RBI uses the cash reserve ratio as a tool of controlling money supply. When CRR cash reserve ratio is raised, banks hold larger cash balances with the RBI. Since reserves are a part of H or high power money, this essentially means that a part of H is withdrawn from the public, equaling the amount of additional reserves. On the other hand, lowering of CRR amounts to a virtual increase in H, which results in an increase in money supply M. In this manner, the CRR serves as an instrument of money control. In case of inflation, CRR is increased, thus decreasing the lending ability of banks. Alternatively, by lowering the CRR, credit expansion by banks increases. Then statutory liquidity ratio. Besides CRR, cash reserve ratio, banks are also required to meet the statutory liquidity ratio requirements. The RBI Act stipulates that banks are required to hold a certain fraction of their demand and time liabilities in the form of liquid assets in their own value. Banks are required to hold a certain percentage of their demand and time deposits in the form of government securities, current securities. These are statutory liquidity ratio. Currently, in 2019, statutory liquidity ratio is about 19.45 percentage. The statutory liquid assets include cash, gold, and approved securities, mainly the government securities. Banks prefer government securities as they earn interest income. The central bank uses SLR to check the money supply in the economy. Increasing SLR decreases liquidity in the economy. However, CRR is more actively used by the RBI to manage liquidity in the economy. So that liquidity to control the liquidity, the CRR is the most effective measure, and it controlling money supply, and when its CRR is raised, bank hold larger cash balance with the RBI. So, and since reserves are because of that, H is high powered. These reserves are part of the high powered money. Then lowering of CRR amounts out to a virtual increase in age, which results in an increase in money supply. M. In this way, CRR control as a instrument of monetary control, and it control inflation. Then qualitative instruments. Qualitative instruments may not lead to changes in volume of money in the economy. These policy instruments are used for discriminating between different uses of credit. Thus, these instruments are used for regulating credit for specific purposes. Some of the instruments are for selective credit control. Selective credit control relates to qualitative method of credit control by the central bank. The central bank can take steps to channelize credit to priority sectors. Similarly, it can impose restrictive measure on credit to certain sectors. In India, such controls have been used to check speculative hoardings of essential commodities such as food grains to check their price rise. When credit flow for purchasing and holding such stocks is restricted, traders increase the market supply of these commodities and their prices do not increase as much. In selective credit control is the method to credit control credits like in speculative manners, in speculative hoarding cases, and it is free from the agriculture sector. The credit is controlled in the speculative sector, and it is free to the rest some sectors like agriculture, small scale industries. When credit flow for purchasing and holding such stock is restricted, traders increase the market supply of these commodities, the essential commodities, and then their prices do not increase as much. Hence, selective credit controls help in moderation of inflation or control inflation. We will find several examples of selective credit control in the Indian case. Credit extended to agriculture sector and small scale industry are instances of selective credit control. So, in case of the in case India, there is free the credit control is free in the agriculture sector and small scale industry, but it is restricted in the speculative hoarding sector or in the luxurious item sector. Because of that, the country can the inflation can control and the supply of essential goods can be managed. Then margin requirements. The margin refers to the that part of the loan amount which the bank does not finance. For example, if you approach a bank for financing a loan towards purchase of a house, The bank will not provide loan for the full amount. It may provide loan for about 80 to 85% of the purchase value. An implication of the above is that 15 to 20% of the purchase value should be financed from own funds. A higher margin on loan discourages borrowing. By changing the margin requirements, the central bank can encourage credit flow to certain sectors while restricting to others. That means in, the, in this case also, some sectors have increased the margin requirements and some other sectors there is the margin requires is not restricted. In order to encourage priority lending to certain sectors, the government may reduce margin requirements. Some cases, the government reduce margin requirements because of the it is encouraged by the public, and for that the stability is maintained and also inflation is moderate. Then credit rationing. In order to restrict credit to certain sectors, the central bank may ration credit by putting certain limit on the amount the bank can lend to particular sector or section of the society. Though through rationing of credit, the central bank can perform the following tasks. It can decline loan to a particular commercial bank. It can ask commercial banks to extend certain percentage of credit to priority areas such as agriculture or small scale enterprises. Then the central bank persuades other banks to comply with its policy stance through discussion, letters or speeches or instructions. This is the moral sessions. Moral session can be employed for both quantitative and qualitative credit control. RBI can urge banks to keep a large fraction of their assets in the form of government securities. It can also discourage banks from borrowing excessively during inflation periods. These measures help control money supply. Sessions is also used for controlling the distribution of bank credit. Direct action. Sometimes the RBI can directly take action against a bank which is not following its directives and conforming to the broad monetary policy goals. For example, the RBI may refuse rediscount facility to such banks, or it may charge a penal rate over and above the bank rate. Central banks use a mix of different tools for monetary control. Bank rate reserve requirements, open market operations, and selective credit controls measures should be adopted simultaneously. Direct action is directly with RBI and commercial banks. RBI can directly take action against any bank which is not followed the directives of monetary policy goals. So sometimes to control these sections or to control the credit creation of commercial banks, sometimes RBI may refuse rediscount facility to such banks who are not follow the directives of the RBI or central bank. Otherwise, it can may charge a penal rate over and above the bank rate. So sometimes when to to control the banks monetary to control the banks credit creation policy, sometimes central bank can also use a mix of different tools for this for that these rates are bank rate, reserve requirements, open market operations, and selective credit controls. Then monetary policy in India. The policy targets and instruments of the RBI have changed over the years in line with the domestic requirements and global structural changes. In the beginning years, the Indian economy was in the early stage of development. Thus, there was a strong need for building infrastructure and enhancing production capacity. During this phase, fiscal policy or use of government revenue and expenditure was found to be more important than monetary policy. So, at the starting level, and at that time, the country's important for the infrastructure. So, it cannot be controlled by the monetary policy, and government revenue expenditure is more important than monetary policy. In an effort to incur more public expenditure, the government usually ran into very high levels of fiscal deficit. The fiscal deficit means expenditure is more than the revenue. These deficits were financed by ad hoc treasury bills or borrowing from public sector banks. Such a method of financing the deficit was very sometimes it's inflationary, means it can create in the raise the price, it can create inflation, and which means prices are rising. During the 19, it is shown in during the 1980s. In order to curb this tendency, the monetary policy framework changed in 1986 to target the growth in money supply, particularly M3. After the economic reforms of 1991, the RBI's role underwent a significant change. Steps were taken to curb monetization of fiscal deficit. For example, by 1997, the ad hoc treasury bills were completely phased out. However, monetization of fiscal deficit continued through primary issue of public debt in auction. In order to stop these methods of deficit financing in 2006, the RBI was not allowed to subscribe to the primary issue of public debt. Since 2016, as mentioned, the sole of objective of monetary policy in India is inflation targeting at 4% per annum with a tolerance band of 2%. In April 1999, on the recommendations of the Narsimha Committee, an interim liquidity adjustment facility was introduced. Repo and reserve repo rates emerge as the primary policy rates of the RBI, and the significance of CRR and SLR as instruments of RBI to manage liquidity got reduced. However, the IL in interim liquidity adjustment facility suffered from non-existence of the ceiling rate and no unique policy rate. Hence, since May 2011, the repo rate has become the only independently varying rate under the revised liquidity adjustment framework. In 2016, inflation targeting became the sole objective of monetary policy in India. The Monetary Policy Framework Agreement (MPFA) was signed between the Government of India and the RBI to regulate inflation and bring it below 4% in financial year 2016 and 17. In case of failure on the part of the RBI to comply with the above targets, it is accountable to the government and suggests reasons and remedies to achieve the same in future by a specified date. So, the government's important matter is that the inflation rate is regulated by RBI and it bring it to 2 to 4%. And If there is increasing in the inflation rate, RBI has due to suggest regions and remedy to achieve to the same in future by specific date. Then quantitative easing. When the rate of interest is very close to zero, the economy enters the liquidity trap region. There could be situation where the interest rate is very low and the economy is passing through a recession. In such a situation, there is little scope for further reduction in interest rate. Else, the economy would go on to liquidity trap state. Liquidity trap where interest rate is very low. At that time, the investment is not possible. Here, monetary policy is ineffective and the central bank measures to increase money supply fails. At that time, monetary policy has no role and the central bank's money supply also fails. People are willing to hold whatever amount of money is supplied to them. Here, in this situation, the cash in hand is increased by the public. Public are interested to hold total money what they earn, which leads to low level of saving in the economy. As a result of low level of saving, the level of investment is also low. And when there is low level of investment, there is also decline in the aggregate demand. In order to circumvent the problem of low interest rate, the consequent liquidity trap syndrome, many central banks resort to a different strategy to boost economic activity. At that time, the central banks are take different steps to boost economic activity. Here, aggregate demand stops responding to very low interest rate and a different policy is sought. Money is directly pumped into the financial system process through a process known as quantitative easing. When at the time when there is no saving and no investment, at which cause the decline in the aggregate demand, and that came the economy to stop the economic development. For that, central banks take a different step and to boost the economic activity. That time, money is directly pumped into the financial system through a process known as quantitative easing, which is also known as asset purchase scheme. Instead of printing money, the central bank creates electronic money, which is used to purchase bonds and securities from financial institutions such as banks. When the banks get more liquidity than what they require as reserves, they make a profit by lending out the excess reserves. With quantitative easing, there is an increase in the demand for bonds and securities. The market price of these bonds increases, which is likely to activate the bond market and stock markets. With the increase in stock prices, there is a perception among people that their income and wealth has increased. This is like to boost aggregate demand through increase in consumption expenditure. Further, increase in bond prices means a decline in their yields. Lower yields decrease the cost of borrowing from business, which in turn leads to increase in spending and expands economic activity. This is likely to accelerate investment in the economy. Banks and financial institutions have more usable funds due to injection of funds by the central bank, resulting in increased lending and boosting business investment and economic activity. When the economy recovers, the central bank sells their assets and sterilize in case it receives from the cells. So there is no additional money remaining in the system. The goal of quantitative easing is to inject liquidity in the banking system so that banks can lend money to boost economic activity. In the case of quantitative easing aims to increase aggregate demand while keeping inflation within target bounds. However, there is a danger of increasing inflation through this process. Amidst 2008 financial crisis, policymakers were looking for ways for stabilizing the world economy. One response which emerged in the UK and the US was quantitative easing. Both US Federal Reserve and the Bank of England adopted quantitative easing in the aftermath of this crisis. Japan's central bank first tried quantitative easing to control deflation in the Japanese economy in the 1990s. So, quantitative easing is a direct direct money is directly pumped into the financial system, and which increase the banks which increase the banking system or increase the liquidity of the banking so that banks can lend money to boost economic activity. At the time of the liquidity trap state, where interest is very low, at that time, public is not interested in the banking system. They can keep all his income in as cash in hand. Because of that, there is no saving, and no saving means no invest no saving means no investment or level of investment. When there is level of investment, there is a decline in aggregate demand, and aggregate demand causes the decline in the production sector. Because of this, the at the time, quantitative easing is the best process to inject liquidity into the banking system so that banks can lend money to boost economic activity. Without saving from this process, quantitative easing process, banks have capacity to lend money to continue the economic activity. Quantitative easings aim to increase aggregate demand while keeping inflation within the target bounds. In this case also, inflation is not increased. There is a danger of increasing inflation through this process. Sometimes there is danger of increasing an inflation also in there. This process, quantitative easing process, or it is applied in the UK, US, England, Japan also. So in this unit, we are discussed about the monetary policy. Monetary policy, its aim is to keep the inflation at the moderate rate, that also in price stability in the economy, and there is its more important objectives is price stability, higher economic growth, full employment level, and exchange rate stability. And to fulfill these objectives, there is some instruments also there. Bank rate, repo rate, open market operations, change in minimum reserve ratio, change in liquidity ratio. And these quantitative instruments, among these quantitative instruments, bank rate, open market operation, and repo rate is much more effective in the economic activity. Some qualitative instruments are also present: selective credit control, margin requirements, credit rationing, moral cession, and direct cession. Among these instruments, direct action is much more effective in the to control its monetary policy to control the inflation or keep the economic growth. And monetary and another is the quantitative easing, which is very important to for the economy to maintain the economic activity or to boost economic activity, and which is applied by many countries. So central banks can adopt quantitative easing, which injects liquidity in the banking system and lowers the lending rates of banks. So today we finished about all the monetary policy. Have you any doubt? Thank you. Bye. Finished? Okay. Bye.
हो ठीक आहे. कोणालाही क्वेश्चन विचारा.
Some questions are coming through this section. Important question is what is quantitative easing? Right, Johnny? What is quantitative easing? What is the difference between repo rate and bank rate? What are the functions of RBI? What are the functions of RBI? What is the difference between cash reserve ratio and statutory liquidity ratio? Then in the last chapter, did demand for monies, the important question are describe the Keynesian theory of demand for money, and how equilibrium of determines the equilibrium of interest rate. How equilibrium interest rate is determined through demand for money and supply of money. Then another short question is what is speculative demand? And in section of functions of money, what are the functions of money? What are the important functions of money? Then measures of money supply. What are the measures of money supply in India? What what is in short question? What is high power money? What is hot money? And another question is credit creation of banking system. What is credit creation of banking system? Then another question, how does ATM facility affects the velocity of money? These are some important questions for exam, probable questions for exam. Okay, this one is last class of 133 BECC economics. Okay, then bye.